A lot of uncertainty ahead, and markets don't like uncertainty. Oil was expected to hover around 70 for the rest of the year. But now everyone is figuring out, is it going to be 80, is it going to be 90, is it going to be 100? I'm in the camp which still believes that the attractiveness of large cap valuations are still at the top. This AI deflation is going to be a multi-year problem for the sector. It's not just a one-year problem. The macro fundamentals, the micros of many sectors, currency outlook, the fiscal deficit outlook, the inflation outlook. So I think until we get clarity on that, many of these FIs which had come back would again probably sit on the sideline.
Last 2 quarters, mid caps and the small caps were in the forefront of the earnings growth. So when is the double digit coming? Hello everyone, welcome to this session, Portfolio Dialogue with the Fund Manager. And today we have with us Rahul Baijal, who manages our HDFC Large Cap Fund, our Business Cycle Fund and HDFC MNC Fund. Hi Rahul, welcome to the show.
Thank you for having me here.
To begin with, Rahul, the world has become very fast-paced. Today we are in the middle of a big geopolitical crisis, a war situation. Oil has risen sharply. We will cover geopolitics and oil, but the point I'm trying to begin with is that the narratives are changing in a very fast manner. A few days back, it was the AI disruption, impacting the IT sector. Both good narratives and the bad narratives. There was the trade deal that materialized with US and EU. Before that, it was the budget. We had trade war, tariff war related narratives impacting the market. Before that, it was the gold and silver rally was the talk of the town. So, in fact, couple of months back, we released our yearbook, and a lot of things that we covered, those things are no longer in focus at this point. They are not even the discussion points. So, amid all this fast changing narratives, on an almost everyday basis, how do you first of all differentiate noise from the real significant developments from a portfolio construction point of view? Do you tactically deploy cash with the help of this volatility on a daily basis?
Yeah, so I think filtering signal from the noise is a key skill which all FMs have to develop over the course of their journey. So that is very much relevant in this context as well. You mentioned a lot of macro events, and actually, 1 year back, if you would have told me that so many macro events would have happened, who could have thought so many of them would happen over the course of 12 months. So in terms of the framework, the way I approach these macro events, I think I classify them into 2 buckets. First is the fundamental bucket, and second is the market risk bucket. So as far as the second bucket is concerned, the market risk bucket, usually you typically have a correction over a short term, and these events create volatility, and fundamentals don't get impacted much. And usually these events give you an opportunity to play around with the portfolio and, let's say, buy something which you were meaning to buy earlier, right? You've done the research, done the hard work, and you're waiting for the right price. So you get the right price sometimes in these events. So these events are used to your advantage. As they say, volatility is being used to your advantage. Yeah. The first one are slightly more difficult to tackle, the fundamental events. So like you mentioned, in IT, we have this AI deflation, which was more of a sector level event, and it has its implications on the micros in terms of company specific bottom up, and more recently oil, which is a macro event, and this has far reaching implications for many sectors, not just one sector, and at an India level as well. Yeah. So the fundamental events need to be, assessed more deeper on a top-down basis and, on a bottom-up basis.
Out of few things you mentioned, oil is right now is the most discussed thing right now. Oil is on the boil. And for India, oil has been a risk in many times in the past. Like whenever oil price goes up, there's a lot of sectors get impacted. The rupee goes down, inflation is impacted. So, how do you deal with this situation today? Because you said there is a fundamental, like you mentioned that there are events that impact the fundamentals. There are something that is on the macro market risk perspective. So which are the most vulnerable sectors this time around, and which are the most resilient ones when it comes to this overall evolving geopolitical situation?
Sure. So it's evolving, like you said, and I'll give my take on the issue, and I'll throw in a few perspectives because it's still evolving. So I think, firstly, for India, if you look at the last 10 years, we've done a very good job of managing the macro stability across various indicators, whether it's fiscal deficit, interest rates, inflation, growth, all have been managed. Even currency. It's only around COVID that we had issues around fiscal deficit, but even that has been under control over the last few years. But oil is something which is not under our control because, firstly, we are dependent on imports.
External, yeah.
80% of our oil is approximately imported, and almost half of it comes from the Middle East, which is where the supply constraint is. So it's not just the price, even the physical supply, we are dependent to a great extent on the Middle East. So I think this is a clearly a variable which can impact so many other macro stability indicators if this crisis gets a bit prolonged. That is a big if which is being debated. And in terms of implications, it has sector-wide implications. Oil is and its derivatives are consumed heavily in the manufacturing sector. To give an example, cement is clearly one area which is heavily dependent on oil and its derivatives. We are already seeing news flow in the press of some sectors talking about constraints on the gas supply. So I think clearly if this crisis continues for long, it will have fundamental implications as well. Another way to look at it is that when we began the year and oil was around 70, and most assumptions in our models, in the sell side models, even when the budget came, oil was expected to hover around 70 for the rest of the year. But now everyone has gone back to the table, to the drawing board, to the Excel, and figuring out, is it going to be 80, is it going to be 90, is it going to be 100? So I think that's the range of sensitivity all of us have to go back to the table and work on, and then create different scenarios and then accordingly take action.
Okay, so is 100 the worst case scenario?
Well, it touched 100.
Sorry to put you on the spot
a few
there.
days back, and it's hovering around 90 now. But nobody really knows. In the next few weeks, there's so many variables involved. There's so many actors involved in the war, and each have their own agendas and pain thresholds. So a lot of uncertainty ahead, and markets don't like uncertainty. So I guess we'll have to bear the volatility. But I think all of us have to go back to the drawing table and figure out some scenarios based on the ranges I mentioned.
The other side is the market prices. The stock prices have fallen. In some cases, significantly. In some areas, not so significantly. But from an overall indices perspective, I think most of the years, if you see the drawdowns on, say, Nifty or Sensex from top to bottom, this kind of corrections is like we have seen many years. This is not like the first time markets are seeing this kind of a correction. But the valuations from a headline, the print, the PE perspective, I think has fallen down. But you also mentioned the fundamentals also getting impacted. So what is your sense of the overall market valuations? And within, see, you manage the large caps mainly. Large cap is the fund you manage, which is the larger fund you manage. So from a market capitalization perspective, where is the most value that has come in this overall correction scenario?
Sure. So let's go back a bit in the past, and let's leave the last few days in March, and let's go to end February. I think sitting in end February, the way earnings were looking, I think the outlook was quite constructive. We had 2 years when earnings were slightly below the trend line. FY25 Nifty ended with about 2-3% kind of a growth, and FY26 we were heading towards a mid-single digit kind of a growth. But the last season, the third quarter season, we saw fairly good earnings from various companies, and no downgrades after almost a gap of 6 quarters. So for almost 5-6 quarters, we had a downgrade cycle. So at least the comfort had come that the earnings downgrade cycle seems to be getting over, and there was clear visibility emerging of a double-digit kind of an earnings growth beginning FY27 onwards. And many sectors on a bottom-up basis were throwing those prospects. So I think that was end February. Now, like I said, one depending on where the various oil scenarios end up being over the course of time, you'll see some upgrades, downgrades happening to that framework. And accordingly, we've seen a correction also, a 5-6% correction in the Nifty, since these events started to develop in the last few days. So let's say one way to look at it is that Nifty's, let's say, projection was, let's say, for the sake of argument, about 12%. The 6% correction is broadly shaved off half of this earnings growth for FY27. So that's what the market is telling you right now.
Sure. So any sectors that can lead this earnings growth forward? You mentioned the single digit earnings on the large caps. I mean, last 2 quarters, correct me if I'm wrong, the mid caps and the small caps were in the forefront of the earnings growth. Large caps were a little behind with a single digit. So when is the double digit coming? I mean, that's the big question people ask. I mean, markets have consolidated, so have been the earnings. So the big wait, when it's going to be over?
Yeah. So like I said, I think there was visibility of double-digit growth, and it still there is. If let's say the oil price goes back to where it was a few weeks back, I think those kind of projections, end February projections, will come back again into play. But it's an evolving situation, so we have to wait and watch before forming up a particular number. But on the valuations front, I would say, as far as the large caps are concerned versus the broader market, I'm in the camp which still believes that the attractiveness of large cap valuations are still at the top.
Still better.
Still better. And just to give some more color to that, if you look at the large cap valuations, it's broadly about a 10% premium versus the long-term history of, say, 10 years. If you look at the broader markets, the premium has come down a lot from September 24 levels, but it's still hovering in the 20s, mid-20s kind of a range. So clearly on that metric, large caps look slightly more attractive. Another way to look at it is, if you look at Nifty, today's level, we are at 24,000. 6 years back, pre-COVID, we are actually around 12,000 levels. So in the last 6 years, we have given a broadly a 12% compounding.
Sure.
Which I would say is reasonable, given in line with the nominal GDP growth. So I think, given the earnings perspective, the correction in valuations, more reasonable on a relative basis versus the broader market versus their own history, and the prospects for growth over the next 2 years, I think make the case for large caps really attractive in my view.
Sure. I mean, looking at your portfolio, the large cap fund, it's mostly true to label, I would say. Large caps are your clear favorites because you have 85%, around 85% in large cap and little bit in mid caps, but small caps are completely missing in your portfolio. Like, I mean, throw some light on this kind of positioning, because there are many sectoral opportunities that can come in the small cap. You are allowed to hold some bit in small cap, even though it's a large cap fund, but any reason you have not ventured into them? Because I mean, I completely appreciate the fact that it's a very true to label. People want to take exposure to large caps, but is there any apprehension on the small cap?
Yeah, so we have stuck to true to label, like you said, that's the right word. And in fact, if you look at the last 3.5 years of this product journey, consciously we've gone out and said that we will not have any small caps in this product, and this will remain a true to label large cap oriented fund with at least 80% in large caps at all points in time. And it's hurt the product in the broad upcycle which came in the broader market in 23-24. But at the same time, it's helping the product in the last 1 year as well. So I think our plan is to continue to be true to label, and the exposure will not move towards large caps at any point in time. Yeah.
Rahul, we discussed the little bit on the IT sector in the beginning. You did mention, but you've held significantly underweight positions on the IT sector for some time now. It looks like, I mean, your call on the AI disruption kind of went well. I mean, it has worked well for you in terms of the portfolio attribution and the returns, etc., etc. So what is your thought at this point in time? Because these stocks have seen significant derating or corrections. So is there a level beyond which you will say, okay, this is like too much is done, there's certain attractive levels, and maybe you'll start adding to those positions? Are we there yet?
So, are we there yet is the question I asked myself early this year. And like you said, this fund was running a big underweight for most of last year on a relative basis, very much on the higher side underweight. And that's helped as well. So, my call was to have a reassessment early this year. But once this a new set of news flow came around AI deflation early this year, uh, what set me thinking was whether it's the right time. And the more deeper I've gone and talked and consulted with various experts and analysts, my sense has been that this AI deflation is going to be a multi-year problem for the sector. It's not just a one-year problem. And what's happening is that essentially two things. Firstly, you're having the productivity levels going up because of better coding tools available. So, an IT project which needed 10 engineers, it can be done with 7 engineers. So, 3 on 10 is a 30% productivity saving. So, on the back of this, what's happening is that many of the deals which are getting renewed in contracts from Fortune 1000 companies, it seems many of them are asking for better bargains in terms of lowering the contract values because of pass through of these productivity gains. So that's one. I thought it might be a phenomenon for 1 year, but it looks like it may continue this year and maybe next year as well. The second thing, which is more a recent phenomena in my assessment, is that the competitive intensity is going to change. So what's happening is that earlier you had the IT services companies servicing the Fortune 2000 clients, and you have the SaaS players. But now, last few months, you're seeing that a new set of companies, which are AI native companies and also working closely with the AI infrastructure players, they may start to pose new competition to the IT services companies. Plus, the captive teams in large companies, large banks, those captive teams are now more enabled to code more with less people. So, I think the productivity levels of the captive IT teams also goes up. So, basically what's happening is that over the next few years, my sense is that the profit pool which was available mainly for the IT services players will also shift towards the AI infra, AI native, and the captive IT teams which large corporates have. And this combined together, I think, will probably pose a multi-year challenge going forward. So the short answer to what you asked is no. I've still not gone back and changed my underweight. I'm planning to continue with the underweight.
But there is some price beyond which you may look at.
Yes, but the price levels, clearly valuations have got far more reasonable. But at the same time, if I compare them with pre-COVID levels, they're back to those levels. So, it's not that they've gone cheaper than those levels. So, maybe when they get cheaper than those levels, then maybe I think they get more attractive in my view.
Can we say that, I mean, one final point on this, like, so when it comes to a major change impacting a sector, let's say maybe the EV coming of EVs in the automobile space has been relatively slower than what we thought, and probably that gave the time for the existing players to adapt. So can we have a similar scenario? If it takes for enterprise adoption of AI, if it takes some time, would that give the existing players some time to adapt, and then over a period of time they will also be in that the shift or the changes that you are mentioning? Would that be a scenario, so that it's not an existential threat, but they have to adapt and then they will do all right?
That's a good point. I think that's a counterpoint to what I just said. I think that's what is known as the deployment gap. The deployment by the corporates could happen at a much slower pace than what the technology change is happening, and that could lead to more time for these companies to adapt better. So yes, certainly, I think that's something to be monitored, and if that pace of adoption is much slower, that will warrant a reason to get or turn more positive, more constructive on the sector. So you're right. I mean, that is something to be monitored as well. Yeah.
Sure. See, from a portfolio construction angle, while our overall AMC philosophy is to have balance between the styles, value as well as making sure the businesses are of good quality and are potentially growing at a particular rate of growth, we have seen and have ample discussions with you wherein we've heard from you that you do have this tilts or sometimes bias towards either growth side or the value side. We've heard from you like that in the past. So at this point in time, where do you kind of tilt your overall, which part of the equation do you favor at this point in time?
So if you look at the large cap portfolio positioning right now, I would say it has a growth bias. If I were to quantify it further, maybe 80-85% growth bias versus value. 3 years back, it was more like kind of 50-50. So certainly it's changed, and a lot of the change also happened as when the value rally happened in 23-24, and a lot of profit booking was done in many value stocks. A lot of them belonged in the PSU domain as well. So clearly there has been a shift in the portfolio positioning, and now when I look at the portfolio, it's clearly more growth bias, more quality bias, and more private sector bias, and that's how I position it for the next upcycle as and when it resumes.
So
over the next 2-3 years.
80-85% looks to be a significant growth orientation. So
As of now, yes.
in terms of your sectoral overweights, underweights, just to discuss a few points on that. Consumer discretionary is currently overweight. Correct me if I'm wrong on that. So any reason for that? And you can take us through, there are any other significant overweights that you currently have? Maybe give us some rationale on that.
So yeah, consumer discretionary is a key overweight, and within that space, I would say two reasons. Firstly, there are a lot of bottom-up ideas available in that space, and if I look at the sector as a whole, retailing and autos and even telecom, I would classify in consumer discretionary. I think there are ideas available on a bottom-up basis. In retailing, many businesses are doing well because they are gaining market share from other players. It's happening in jewelry retailing, it's happening in value commerce, it's happening in quick commerce. So a lot of interesting ideas over there. In autos, as you know, the GST cuts which happened late last year along with the income tax cuts, we have seen a stimulus, conscious stimulus being given to boost consumption by the government, and that's showing up in the numbers over the last 5 months across the auto sector, whether it's two-wheelers, four-wheelers, tractors, CVs. So I think that's an area of excitement which should continue. And telecom, I mean, I classify it in discretionary because at the end of the day, it's very much a B2C kind of a sector. I think a lot of headroom is there in terms of pricing power and growth. So I'm quite excited about this space on a bottom-up basis, and top-down also. If you look, the government's focus after the announcements last year, there seems to be a slight tilt towards boosting consumption. A few years back, the focus used to be mainly capex. And actually spending a lot on capex. And last year, the focus seems to have been shifted slightly towards consumption and kind of encouraging private sector to boost the capex front. So I think the top-down policy front environment also is more conducive for consumption, and while these measures continue to have a decent impact, My view is that if things don't come out as good as expected, maybe there is potential for more policy measures to come through. So I think on a both bottom up, top down basis, this space looks attractive for the next 1 or 2 years. Yeah.
So, okay. So, any threat from this overall evolving situation? Because I think the cooking gas and other areas is where the main issue. It can potentially have some impact on how people behave when it comes to consumption. Do you see any immediate threat? While it's a really a long-term story that can work well for wealth creation, but in the immediate, because of this overall situation, do you see any concerns there?
Yeah, like I said, we have to do our analysis in terms of scenarios, and I think in the short term, if we have a quick resolution, I don't think any direct impact. In a scenario B, in which it's more of a few months kind of a issue, there could be some impact. But I would say the impact on a even if this continues for a few months, there are other areas which will get impacted more. So on a relative basis, I think these spaces should still be fine.
See, from an overall markets, I mean, FII flows has always been at least in the last 1.5 years, been a concern. There have been significant amount of outflows did happen, did impact the rupee on that count. February was a month when we saw some glimmer of hope there.
Yes.
There was a slowdown, at least with the trade deal and everything. At least we did see reduced outflows, or few days there was inflows as well. And again, this situation has resulted in a lot of outflows. So, do you see any change to this situation, especially valuations are down? So, do you see, how do you think FIIs will be viewing India as a country? Because this is a global crisis. I mean, not only India,
Yeah.
I can see a lot of Asian countries wherein there could be bigger impact as well. So,
Yeah.
how do you see the situation there?
So again, let's dial back a bit. On the situation was very different February end, and now we are sitting in second week of March. I was fairly constructive and very constructive on FIS coming back in a meaningful manner in India this year. And last year was a year of big outflows, close to $19 billion, which was the highest ever absolute outflow from India. And FIs was selling India for different reasons. For some valuation was a concern, for some lack of earnings growth or earnings growth not being very attractive was a concern, for some currency was a concern, and all three were valid reasons, at different points in time. And another set of FIs were playing this AI trade in markets like Korea and Taiwan. And India was so called the anti-AI trade, so they were not coming here. But I think 3 out of these 4 reasons had begun to change for India, and clearly valuations, like we discussed earlier, had got more attractive. Earnings downgrade cycle got over and was looking to be in a phase of stability and possible upgrades. And even currency, after the deals, the European deal late Jan and the US deal early Feb, I think it changed the sentiment on rupee, I think. So on the back of that, you saw what we saw in February. The FI inflows did come back. So I was hoping for this trend to continue, but now again we are in this the oil complex scenario in which impacts the macro fundamentals, the micro so many sectors, the currency outlook, the fiscal deficit outlook, the inflation outlook. So I think until we get clarity on that in a more meaningful manner, many of these FIs which had come back would again probably sit on the sidelines. But I think once we are through with this, we get more clarity as to where things are heading on the oil price front and the availability front. I'm sure many of them will have a relook at India and probably come back later this year.
Sure, Rahul. I think we have covered the outlook part extensively, but when it comes to individual investors, the same question they ask in a slightly different way. What should I do now? Okay, is the correction, is it enough? I mean, should I invest a little bit today? I mean, that's the question. I'm not going to ask you that question straightforward, but what we typically tell them is that, yeah, probably you should stagger your investments. So maybe a systematic transfer plan is a good way to enter this market at this point in time. So what is your overall outlook? Like how should a retail individual investor go about doing his or her asset allocation given this? Is there a significant market movement already happened that some shift towards an aggressive manner equity allocation can be increased? So how would you address an equity investor's concern at this point in time?
I would say, if you again look at scenarios and probabilities, let's say a mild scenario of oil impact and a moderate scenario and a severe scenario. My sense is that a mild to moderate impact is already priced in. Given what I said earlier as to how things were looking February end, I would fairly be constructive. On the third probability of a severe scenario of oil prices remaining high for a prolonged period of time, the supply from Middle East getting restricted for a prolonged period, maybe it's not fully priced in. So keeping these perspectives and which bucket you are in is how I would approach, allocations going forward.
So staggered investments
Would make more sense.
would make more sense. Thank you, Rahul. It was amazing discussing the markets and the portfolio positioning with you. Thank you very much.
Thank you so much.
Thank you, everyone. Thank you, all the audience, for joining this session. Thank you all.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.